Financing a new build. Here are the 3 best ways to do it. Now, if you're interested in, at some point, either now or in the future, getting into a new build property, well, hey, keep watching. I'll explain to you the 3 best ways to finance it. Now, if you're thinking about building a property from scratch, i.e. out of the ground, then the first thing you need to consider is who's going to live in it. Are you going to build it for yourself, i.e. for your main residence for the future, or build it to hold on to and then rent out for someone else to live in? Now, if you're going to build it for yourself to live in as your main residence, and hey, there's a lot of people that have dreamed about doing that, haven't they? You know, build your own place exactly to your spec. I can see the attraction in that. Well, there are specific mortgages called self-built mortgages that allow you to do that. They will finance part of the purchase, but they'll also finance all of the build costs and that main residence mortgage rate. In other words, it's the cheapest you're ever going to borrow money at. 2 caveats here. The first one is, it is only for people that want to build their own property to live in. Now, because the rates are substantially cheaper than commercial finance, these self-built mortgage lenders are acutely aware that developers might want to muscle in on this to get some cheap borrowing. So they're very, very focused on smoking out would-be developers trying to do a cheap deal. And in the past, when we've brokered these type of self-built mortgages, we have seen them pull out of the funding midway through the build when they've suspected, not proved, suspected that there could be a developer trying to build it and not live in it themselves, but just sell it on. The second caveat is, like any main residence mortgage, what you can borrow is limited to your income and expenditure. In other words, you can't borrow more than the lender thinks you can afford to repay. So if you always plan to build your own dream home to live in, then a low rate self-built mortgage is the way to do it. Now, self-built mortgages are not available if you plan to build it to sell or build it to rent out. Now, clearly these are considered to be commercial developments, so they're financed in a different way. Let's look at that. Now, the major banks were into funding new build development massively in the early 2000s. When the credit crunch hit 2008 and 9, they pulled out. They massively pulled out, and they've never come back in any meaningful way. There's a saying that nature abhors a vacuum, and that's certainly been the case for funding new builds, because in place of the major banks' reluctance to get anywhere near this sector, small, often known as challenger banks, have come in to fill that vacuum. Now, these are not household names. They don't make themselves well known to the general public, but they exist sort of under the radar unless you're actually in property and you know who funds these type of deals. As brokers, we obviously know that. And they're pretty much a one-trick pony because they fund new builds and pretty much nothing else. I mean, a few of them do bridging loans as well. But they just exist for one reason, and that is to fund new build developments, be that a single unit new build or bigger multiple units. But who gets to borrow from these development lenders? Well, they're picky. You know, they're picky about who they take on, and they particularly don't want to take on wannabe developers. Now, taking a plot of land and building a house on it, well, there's a lot of things that can go wrong with that if you don't really know what you're doing. So these lenders have put some barriers to entry in there to keep some of the potentially problem borrowers away from their loans. Let's look at what they've put up to deter all but the strongest applications. And these fall into 2 categories. Firstly, a significant cash deposit. Secondly, relevant experience. Let's look at the first one, significant cash deposit. So you're not going to get 10 or 20% deposits easily here. One of the best ways they've found to focus the mind of the borrower is to have a significant chunk of their cash in the deal. Skin in the game, it's often called. Now, the prospect of losing a big chunk of your own cash if you mess up the development, well, that's a great way of keeping focused, isn't it? Now, the cash input required is going to depend on the project and how much the development lender likes the project, and almost equally as much how they like the borrower. So 25 to 30% cash in upfront at the start of the deal, well, that's pretty common and sometimes It could be even more than that. Now, secondly, experience. So what they really want is you to have already done a new build project before they lend you on a new build project. In other words, they're very wary about lending to rookie developers. And even if you've got some new build experience, they're not going to lend if you want to go massively above what you've done already. So let's say you've done a couple of single unit new builds and you now say, hey, I've found this plot, I can get 20 on there. In that case, well, yes, you've got new build experience. What you haven't got is volume new build experience. So that would still be a challenge to make that huge leap. But if you've done single units and you want to do 3, 4, 5, that's probably okay. Now, if you lack a big chunk of cash or new build experience, well, you're going to have to get a bit more creative about how you make yourself attractive to these development lenders. And that's usually bringing someone else in on the deal that can make up for your lack of experience or cash. So let's look now at how the money is distributed for the build. So you purchase the site with a chunk of your cash and the rest borrowed from the development lender, or maybe you've had enough cash to buy the site completely and you just want the build funded. Now, developers particularly like those sorts of deals because they're much lower risk for them. Now, development lenders particularly like those sort of deals because they're much lower risk for them. And the standard thing with build costs for all these type of loans is 100% of the build cost is funded. Why? Because it's their best guarantee you're going to get a finished product that you can either sell or refinance. So they're never going to leave you short of being able to finish a project. Now, that would be self-defeating, wouldn't it? Now, you're not going to need all the money to fund what could be a 6-month build in your account day one. For one reason, it wouldn't be cost effective because you're going to be paying interest on it months before you need to use it. So the build cost is split up into tranches and delivered and paid out to you in stages. And this is almost always in arrears. In other words, you do stage one and you fund it yourself, and then they'll give you the money to pay you back for stage one, which allows you to fund stage two and so on, right the way through until you finish the build. Now, there is some flexibility on these stage payments, in other words, in what part of the build that they occur. But there's a standard classic 5-stage payment system that actually works, and I'll quickly run you through that. So the first stage is all the groundworks where all the sewerage and everything else get put in, up to DPC level, damp proof course level. Developers generally want you to get to that point before they start dishing out any money for the build. And they'll send someone along to check out what you're doing. Usually it's their QS, quantity surveyor. It could, for smaller builds, be the valuer. Now, it could, for small projects, be the valuer that initially valued the project. So they do a site visit, which of course they charge you for, look at your work, sign it off, and the money for that tranche is then in your bank account pretty quickly, which allows you to crack on with phase two. Phase two would typically take you up to roof plate level. Back comes the QS or the valuer, signs off the work, you get that tranche of money, you crack on until the first fix is finished. Back out comes the QS or valuer, you're getting a picture of this now, aren't you? Then you move on to the second fix stage, and finally to the finish and completion of your project. When you get your final visit from the QS or valuer, they sign off the whole build and you'll get your final tranche of money. Now, other payment structures can be agreed in advance with the lender if that typical 5-stage process doesn't work for you. Now, another reason for these stage payments in arrears is that lenders want to keep a tight focus on the loan to value. In other words, their level of exposure at any given point in the project. Now, they will always have a maximum loan to value they want to keep to at any given time. Now, with some lenders, it's 55% of the GDV or gross development value, either at the end of the project or at any stage of it. Now, how do they treat interest due on the money? Well, the term rolled up interest is appropriate here because they will roll it up and defer it until the end of the project. In other words, when you achieve sales, if it's a multiple unit project, or when you refinance it and then rent it out. So as soon as you get some cash coming in, you'll pay back the capital plus the interest at the back end of the loan. And they're going to see the breakdown of a past project, a new build project. Now, they want obviously the site details, the address details, what you bought it for, what you spent on it, and then what you either sold or refinanced it for. So expect to be asked to provide quite detailed information on this so they can check you out. Now, I said earlier that if you haven't got this new build experience, that's going to be a barrier to lending. And just so you know, doing refurbs or doing extensions doesn't count with these lenders as new build experience. So you might want to bring someone else in as a joint venture partner, shall we say, on this project. Not for their cash necessarily, but for their experience. Now, obviously, a builder would be a great person to do that. A time-served builder is clearly going to have the experience that lenders will require. Now, the working relationship with that builder could be quite critical here. And what they're going to prefer to see is the builder as an equity partner rather than a contractor. What's the difference, you might ask? Well, experience has taught these development finance lenders that on a contract basis, if there's some sort of disagreement or a lack of a working relationship between you and the builder on a contract, builders have been known to walk off the job. If they're an equity partner, they're much less likely to just down tools and walk away. So if there are issues, there's a greater incentive for them to work through those issues and get the project to a satisfactory completion. Now, as an equity partner, there's a greater incentive on them to work through any problems and get to a satisfactory completion. And the structure most commonly used is a limited company, but it's termed as a special purpose vehicle, or abbreviated to SPV. This just means it's a company not where you're going to have an ongoing trading relationship with your builder and be doing project after that, but it's a one-off company formed for this build that once you've sold or refinanced, paid back any borrowing, distributed any profits, company would be wound up. So there we are. We've had a chat about new build projects. If that's the thing you're into, hopefully you found some use out of this. Now I'm going to be out next week with another property finance video. So, hey.
If you enjoyed watching this video, did you know every Monday morning at 8:30, I do a live Facebook Q&A. So if you want to start the week with checking out some answers to your property finance questions, click the link here.